we get the big announcement that Nvidia can't send H20 chips to China, among other things, right? So it feels like the entire world is dictated by one dude sitting on his golden toilet with his two thumbs at this point.
Yeah. I don't know what else to say about the market, generally speaking, other than, yes, it's being dominated right now by global trade. The trade war is seemingly the only thing that really matters at this moment. And it's steering the ship on everything, and whether it's the broader market, the S&P and the NASDAQ 100, or if it's individual names like Nvidia today. It's just that's what is driving the narrative, and that narrative is all reaching at this moment.
And for those of you who don't know Brett, let me read his bio here. Brett Kidwell is the U.S. investment analyst at eToro, the trading and investment platform empowering you to invest, learn, and share. Brett has spent his career focusing on market research and analysis. Brett's work has been featured on CNBC, Bloomberg, Yahoo Finance, CBS, and Forbes, among many other publications. And prior to joining eToro, Brett worked as a financial journalist for The Street, covering a variety of beats, including the auto sector, technology, space, and most recently, the technical setups for the U.S. indices and individual stocks. So dude knows what he's talking about. That's what I'm trying to get across here. Brett, bro, I'm so glad that you're here joining us today. Dude, it's crazy, right? Everywhere you turn, it's tariffs this, tariff that, trade war this, trade war that. And I mean, just look at the market today. This is brutal, right? Apple down 4%, Nvidia down 10%. And you would think that if Nvidia can't sell chips, maybe investors are going to flock over to AMD. No, you can't hide. You can't hide anywhere in the tech sector. It's going to take you out one way or another. So, Brett, I want to know, if you don't mind, give us a little backstory on you, and tell us what you're looking at these days. Because in a market like this, I've been telling people just hold cash for a hot minute, but you probably have some better ideas than I do. Tell me what's going on.
You led in the beginning of the show talking about like position size and just kind of like emphasizing it's like one of like such an important core trading and investing principle, really. Obviously, if you're more of an active investor, which I assume most of this audience is a little bit more active than like your general DCA type of investors who are just putting their money away in a retirement account or like passively investing in ETFs. But if you are being more active in this market, position size is so critical to this, because it gives you an opportunity to be involved, but also change gears. Like when you're wrong, it's easy to stop out when you're sized right and you have a position size that's not going to get your account crushed when you're wrong, because inevitably you're going to be wrong in tapes like this. It just changes too much, and as you mentioned earlier about mega caps, like Nvidia is a great example. It looked okay, prior to this headline. But that just shows how quickly things can change. And if you're trying to swing trade in this type of tape, which a lot of traders are swing traders, position size is completely paramount, because the overnight risk or the weekend risk is just so high in a tape like this.
Yeah, for sure. And I'm really glad that you led off talking about position sizing, because that's something that I talk about constantly, right? And it's one thing that I like to do is let me share the charts real quick. One thing I like to do is I like to look at ATR. So when I was learning to trade, I learned to trade from 5 different market wizards, and Larry Height was one that talked to me about ATR. And that's how you can position size based on volatility. And right now, ATR has expanded. The average true range has expanded on the SPY. It's around 17, let's call it 18 right now. And just a few months ago, it was down at like 4, right? So we've nearly got 4.5 times as much volatility today as we did just a few months ago. And I'm telling people, right, if volatility has expanded by that amount, you need to compress your position size by at least that amount, right? If you're trading, let's say 200 shares, maybe you need to be trading 50. And to some people, it's like, well, I can't trade 50. What do you mean trade 50? That's not even worth my time. Bro, if volatility has expanded, has quadrupled, and your position size is still the same, you're about to get monkey hammered without even realizing it. So that's my opinion on it. What else are you looking at right now? Like there's a lot of people talking about bonds. Why do people care about bonds right now?
I would just say, so I guess first and foremost, like my lane is certainly on the equity side of things. But when you look at, I think if you like take a step back and we go, this correction began really quickly. Like I was out of town the week of February 18th, which is the week that the S&P last made its record high. By the time I came back to work, the moves we saw under the surface, so not so much in the index, but in the groups that have been hit the hardest right now, which is tech and consumer discretionary. So many of those names had already come in. And I wasn't out of town for very long, just to be clear. These names were killed in just a couple of days, in like a week span. And at first, that correction was kind of contained to tech, and it was really in U.S. equities, but mainly in tech and consumer discretionary. I think at the end of the quarter there was still, this is off the top of my head, but 8 or 9 of the U.S. S&P 500 sectors were still beating the index year to date, and 9 still are. So it's really been concentrated, but we've seen that volatility really expand now. I mean, it's gone beyond just equities. We've seen it in fixed income a week or so ago, when we saw that big spike in long duration yields. We've seen it in the currency markets. We've seen it in foreign equities. Because at one point, foreign equities were a pretty good. I think if you came into close to the end of the quarter or most of the Q1, a diversified portfolio of U.S. equities, foreign equities, like gold and bonds, you were sitting in a pretty good spot, with the exception of just the one part of your portfolio which was lagging, which was U.S. stocks. We've seen that volatility filter through seemingly every corner of the market at this point.
So what do you think about all these YouTubers, which, clearly is not this channel, all these YouTubers who are like, $75 in this one stock and you'll never have to work again. This is the market bottom. Time to load up the boat, right? Or the ones that are screaming like AMD down, down to almost zero at this point. The advanced money destroyer, which has been going down straight towards the Gulf of America for months at this point, right? Just for a little context here, let's take a look at AMD to set the stage here, right? Surely Brett is familiar with AMD, right? The ones who are screaming, you've got to buy this stock. This is a generational low. What do you think about a stock like this? Is this something that Brett is buying because it's in a generational low?
And AMD, that stock was doing bad before all of this stuff happened. I mean, even before the Trump administration started, even before 2025 came along, AMD was not doing well. Investors are looking at this name as a value play, as an opportunity. And when you look at the the growth expectations, when you look at where they are fundamentally in their valuation, and given the fact that the stock had fallen like 50-ish% off the highs, come to the weakness we've seen now, I think there was a case to make that this was becoming sort of a value play if you're looking at it on a multi-year kind of perspective. If you're looking at a technical perspective, I don't really see where the draw would be to get involved with AMD personally. But in terms of where it stands in the market, I think investors are looking at the chip space as a one horse race right now, and that's been Nvidia.
Right. So let's shift gears over to Nvidia real quick. Like, I look at this stock and I'm like, no way, stay as far away from this as possible. Now, granted, over the last few days, I thought it had some legs to it, right? We had a double order block below here. Then it created a third order block right here. Now, order blocks are large institutional orders just waiting to be filled. And you can see it bounced literally right out of that block right there. And then it started making some headway, right? Crossed over the 20, crossed over the 10, and had a couple closes over the 10 and the 20. And just yesterday, I was saying, I think this has some legs here. But then a 10% down move today, basically because they can't sell their chips to China anymore. And it's so frustrating, right? It's so frustrating looking at this market for opportunities and having something like this happen to you. So in the chat, go ahead and start typing out some questions that we can ask Brett. But I'm looking at this market and I'm like, I'm just going to hang out in cash. I'm going to hang out in cash for as long as it takes, right? In fact, Minervini, Mark Minervini is one of my mentors, and I always use a slide deck whenever I'm talking on screen here. It just makes life so much easier. But I like to reference things. And so one of the quotes that I like to reference is right here. So Mark Minervini is one of my mentors, and his key 6 trading rules are: number 1, wait in cash for proper setups as long as it takes. And dude, I'll sit and wait and wait and wait for weeks and weeks and weeks. But I know that there are opportunities out there. I know that there are other things that I could be putting my money at work. Where would you be looking at these days?
I guess if I'm looking at the market from a more of a fundamental perspective, I do think we're starting to get some value opportunities. It was a little hard. It's hard to kind of make that observation now after such a significant rally that we've seen off of last week's lows. But I think when you start, and I don't really say this in hindsight, you do have to be sort of forward looking in how you're approaching this type of thing. It's not just me looking at the chart is a good chance. But when you really zoom out on some of these bigger names, like maybe a Google, a Microsoft, even an Nvidia, even though it's in the crosshairs today, there were some levels where it started to make sense to get involved with these names. Even in the SPYs and the Qs, they really started to back down into levels that were retesting the old bull market highs from late 2021, early 2022, timing up with that 200-week moving average. There was a reason to be involved from lower levels. Now that we've seen that big move, now it's when you have to know what is your time frame, and you have to know that before you get involved with these positions, because that's how you're going to make your decisions on whether you exit or trim or you hold tight. I think when you look at something like the SPY, even if you were an intermediate term investor / trader, active investor, you see it kind of run up into that declining 21-day moving average, can't get through it. You see it run up towards 550, which was prior demand, or prior support zone. Now it's a resistance zone. You kind of see these observations, and it's a clue. You can bias you want, or views of the longer term market, but this is what price is telling you right now. It can't get through. If it gets through, then that changes the perspective a bit. But I think that's your chance to lighten up. It's your chance to hedge. It's your chance to raise cash. You just got to listen.
Yeah. I think you've got a great point there, Brett. And this is something that we do every single day when we talk about how, it could be the best stock in the world, but if the price is going down, you're not going to make any money because only price pays. Sorry, that's one of my props. I have to do it. Everybody asks for me to do it every single day because only price pays, man. The only way you're going to get paid is if price is going up. And I like to say this all the time. All stocks are bad because they have market risk. But every once in a while, they act right. Every once in a while, they act right. So there's a couple questions in the chat. Let me pop these up real quick. Let's see. Salty Brad says, is there a place to put cash that is not volatile but can still work for us? What would you suggest?
A place to put cash, but you're trying to nix volatility. I mean, short-term bonds would be a place you could hide. Money markets are always a place to wait out a storm. Cash is a great position to be in, honestly. I mean, I know you've reiterated cash a few times, so I believe you have an affinity for it, but it puts you in the ultimate neutral emotional spot, puts you in a spot where you can take opportunities, and it just gives you a lot of flexibility. I mean, cash is a good place to hang. Now, you don't want to be, if you're thinking from a long-term perspective, you don't want to miss out on opportunity and potential that comes your way in the market. And it doesn't have to be in the stock market necessarily. It should be whatever market that you feel most proficient in. But cash is that starting point where it gives you all the flexibility.
Oh yeah, for sure. And then what I'm loving about cash these days is that Trump can't change that right now. Granted, there's of course opportunity costs that I could be putting it into high yield savings or short-term bonds, something like that. But I'm okay with that risk. I'm okay with letting that couple percent for the year slide by because I want to be able to have that cash ready to go when I need it. And so speaking of Trump, right, we hear him all the time talking about how tremendous these tariffs are. China is going to have to pay 1,000,000% tariffs by the end of the week because they are so stupid. They are so dumb. They are not intelligent like us in the United States, right? We hear this all the time about basically it's Trump versus China. Where do you think the end game is here, right? Because I'm looking at this and I'm like, as a consumer, I'm thinking, okay, tariffs are going to make everything that I own go up because I look across this table in front of me, my monitors, my computer, my microphone, my phone, my DuckTales mug that I use to drink out of every single day. Every single thing in front of me basically was made in China, which means every single thing in front of me is basically going to double in price, right? Because it's not like they're going to eat it. So that doesn't help me at all. And then Trump saying, oh, we're going to replace income tax with the tariffs. It's going to be great. You're going to have so much more money. I just can't get behind the fact that we're going to have more money from not paying taxes versus having to pay tariffs. I can't get behind that. What do you think?
Yeah, I'm with you. I to be honest with you, I think the market sums it up almost in the best way possible. It's like the chart is like a picture. It replaces 1,000 words in this case. Like if the market's apolitical, it's not going to be a Republican or a Democrat and have a bias in that. It's just going to look at how this affects the economy, corporate profits, visibility, certainty. it does not like what it sees. Very clearly, understandably so. The trade war situation is something that is changing. I mean, sometimes hour by hour. At the very least, feels like day by day. I mean, at one point early on in the trade war, so we have like a group chat with the other analysts at eToro, and they're all over the world, a lot in UK, some in Australia, and we would chat back and forth whenever there was a new tariff headline. You can imagine how quickly that group chat fell apart
Yeah,
because it
quite a lot.
was simply impossible to keep up with. And that's the environment we're in, and unfortunately, that type of environment just leads to sky high uncertainty, and you're seeing it on the consumer level, the business level, and the investors level. And when all three of those groups feel uncertain and they don't have good visibility, I mean, you have companies now like United Airlines providing two sets of guidance. One is for here's what's going on right now, here's what happens if things get significantly worse from here. And that's if they're even providing guidance. That's a way for investors to navigate an environment in a clear and concise manner. So I don't think that the trade policy is being approached in the correct way. I don't know what the end game necessarily is. It almost feels like Trump and China are both waiting for each other, waiting for the other group to call them, but both secretly hoping that they do so that they can kind of get this put past them. It really does feel like it is those two locked in now that we have the 90-day pause with so many other trading partners. And, a lot of allies are disgruntled. We're seeing the response immediately in boycotting of like U.S. products, boycotting trips to the U.S. These are not really things that are being helpful to the U.S. consumer. So my hope is obviously that China and the U.S., the two largest economies in the world, can, quickly get something done. I don't know that quickly is necessarily in the cards, but
Yeah, that makes sense. So if we're to take a step back and look at, the stock of the day, which is Nvidia, right? What would have been a real red flag for you? Like if we're looking at the charts, what's a red flag for you where you're like, oof, I'm not sure that this is anything that I would touch?
on a technical basis, Nvidia, I don't have the chart up right in front of me. I don't have my chart, I should say, but there was a VWAP level going back, have it anchored back to, was it the breakout from, when did they break out? Was
Okay.
it late?
So let
I
me
think
interrupt
early.
you real quick. So
Sorry.
you trade anchored VWAPs?
Not exclusively. I do. I
Okay.
use them in situations.
Okay, teach me this because I don't get it. And let me explain why I don't get it, right? There's like a million candles on here, right? And I can anchor a VWAP to any one of them. How would you pick the one that you're anchoring? I'll add that on there if you tell me where to put it, and then just explain to me why you would put it there.
So I'll be first and foremost, Brian Shannon is like the VWAP
Yep, I know
expert.
Brian. Yeah.
Yeah, Brian is a king with this kind of thing. He has a great book on it. I will say I don't trade it exclusively. It's just a small component that I apply in certain situations, like key breakout levels or key lows. So, like in the case I'm referring to, Nvidia, there's a breakout from, I think it's like the one of the first trading days of 2024. It is like right in the beginning. It was right when
Okay.
it broke out over, well, it'd be $50, I think, split adjusted basis. Um, it looks like it might be that candle.
That one
There
right
we
here.
go. Yeah.
Yeah. Okay. So create anchored VWAP. Yeah, I know Brian. I've had him on my podcast a few times. Very cool guy. He actually sent me an autographed copy of his book when it came out. So yeah, for sure. So yeah, there's a good bounce right off that in August. And then let's
Yeah.
see.
There
Another
was a
couple
few good
bounces right here.
moments with that for me. There was was it like the April May correction in 2024? So that was like that 5 or 6% correction in the S&P. Then we had the August breakdown. Um, when we had the carry trade unwinding, and then we had the most recent pullback where it held initially. Once that level broke, to me, that kind of was a concerning development. I know it's not the end all be all by any means, but to see that support level hold so many times consistently over the major breakout, really, and then fail, that kind of was a concern to me. But at the end of the day, Nvidia is a major leader in the chip space. It's leading the AI revolution. It's not just a chip company; it's also software it's a great business, but it's susceptible to the whims of what this trade war is, which is it can change on a dime. One day it's exempt, the next day it's not, then it's just 20s, and it's where is the line? Tomorrow are we going to wake up and there's going to be more restrictions on different chips to different countries? We don't know.
Right. Yeah, and so it's interesting to see this this anchored VWAP on here. There was someone who left a comment because I don't get it, because you literally can't anchor it everywhere. That's why I wanted to ask. But Nico said just anchor it to the first day of the year or the month or the earnings or the all-time highs or all-time lows. Right? There's so many different things you could anchor it to. So that's why I wanted to ask. But there are a couple other questions come through, and I want to definitely ask these. So Mahesh, so this is our CEO. Mahesh had a question. Which sector most of eToro users are active, or where are you seeing the most action? Are you seeing increases in trading, or trading investors are holding back? I guess the two questions are here. Okay, so two questions there. Where do you see most people going in the different sectors? And are you seeing any sort of increase or decrease in trading volume? Actually, great questions there.
Yeah, so I guess a lot to unpack in there. So the first one is it's generally tech. I don't think that's probably that surprising to you. So our typical user tends to be on the younger side, generally like a millennial. Your retail investor loves tech. They love consumer discretionary names. They love the names and the brands that they interact with throughout their life, usually on a daily basis. But that's where we get the basis from. Now, when we look at the survey we do, so we do a quarterly survey of retail investors. They're not our investors necessarily. They're just retail investors in general. It encompasses 10,000 investors across the world. We do it 4 times. Allocated sectors, actually financials and fintech, with tech at number 2. So there's a little bit of difference there, a little discrepancy between our users and the general retail investor. But when we look at our investor in terms of what's going on with trading volumes, effectively, are they buying the dip? At this moment, the answer has been yes. And we really saw that prominently. Like if we go back to January, before all the tariff stuff happened, we had that DeepSeek news really rattled the semiconductor space. We saw those buy orders coming in on the mostly on the tech side, but in moments like that, we do see pickups in some of the like semiconductor ETFs, things of that nature. It's not necessarily just Nvidia or just AMD or a Broadcom, but we did see that activity in January, and then again here on April 3rd, so the day after so-called Liberation Day, we had that first big down leg. When we look at our global users, again, they stepped in and bought the dip pretty significantly. How that ends up working out long-term is, we hope that it works out well for them. But generally speaking, yes, they are still pretty active, and yes, they are following the news day to day.
Oh, interesting. So can you give me a percent when you say still pretty active? So if baseline is 100, would you say that it's down like only 10% or so, or maybe even up 10% or so?
Are you referring to the trading volume?
Trading volume, yeah. Just curious.
So the only specific stat I have off the top of my head is that on April 3rd, our average buy orders or new position open orders was 50% higher than the average day through March.
Really? So 50%
Yeah.
higher on April 3rd. That was the day before we got this even bigger move down, right? Let's
Yeah, it was like the
let's
first
scroll that
big.
on the chart here.
Yeah, it was the
Oh,
first
yikes.
like gap
Huh.
down day.
Interesting. I bet that there were a lot of YouTube videos going out on that day as well, saying, now there's the bottom, buy the dip, right? You've got to buy it now. It's generational lows. And the thing, Brett, that I've been saying, right, is there's nothing wrong with buying the dip, but you need to be buying it when stocks are crashing up versus when stocks are crashing down, right? When the dip has finished dipping and it's moving this direction, that's when I say, go ahead and buy the dip. We did an exercise not all that long ago, and let's do it together just for fun. If I scroll back to the COVID lows, and then we take a look at today. Actually, let me do this as a multi-symbol view here real quick. Let's see, SPY on the left, SPY on the right. We did this exercise a while back, and I think it's really useful as far as like when timing to buy the dip. So if we go all the way back to, okay, so here's the COVID sell-off here. So on the right-hand side is today. And so from today, from the highs to today, we're down 14%. from the highs right before COVID to down 14% was right here. So you can see that's not even halfway down, because it was about 35% peak to trough. And let's say that somebody decided to buy the dip today, right? If they bought the dip here, it could be equivalent to this. And I'm not saying that we got 35% down moves coming. I'm just trying to use as close to apples as I can. Now, of course, a lot's different between these 2 points, but we're just looking on price. If you were to have bought it right here, let's say Brett bought it right here, right? Let's say Brett bought it right there. And every day goes by, Brett's losing even more hair. He's starting to look more like Chris. And then it finally hits the bottom, and then it starts going back up. So Chris is on the other end because he's already lost enough hair. He's like, I'm not doing this anymore. And he's waiting for what I call the outlier trend template, where the 10 is over the 20 and price is over the 50. And it's a super simple, three numbers, and people really click with this one. If the 10 gets over the 20 and price gets over the 50, this is the first candle where that happened, right? So let's say that I got in on this red circle right here. I would be at almost immediate profitability, right? Now, of course, a little bit of volatility here, but I would be almost at immediate profitability, and I would be up even 2% by the time you get back to break even. And I didn't have the stress of this movement all the way down, and then seeing if it will find a bottom, and seeing if it'll start coming back up. So I like to make this, and of course, the example is a lot better when you compare it up here, right? Where somebody's up 13% when somebody on here on this side was buying the dip. So my point with that, Brett, is that I'm not ready to buy this market. No way am I ready to buy this market. And I wouldn't be telling anybody else right now, now's a great time to be buying the market, because as you can see, like if we're comparing COVID to now, right, we could have a lot further down. What would you be looking for to see, okay, you know what? Maybe I'll start to nibble. Maybe we found a bottom. Maybe this is where things will start going back up. What would you want to see?
So for my personal approach to this is it's going to depend on what account I'm working with. So I wish I had the mental capacity, the emotional capacity to trade everything in one account and just approach the markets like, oh, this account, this position's for, short term, and this one's intermediate term. I can't do that. I have to separate them out into separate accounts because it's too difficult for me. From an active trading perspective, that account has hardly done anything this year. It is waiting for more clarity. I like to swing trade in that scenario in that account. This is not a conducive swing trading environment for me. The volatility is too high. The overnight risk is too exposed to it. On a longer term basis, I have been putting money to work into these pullbacks, and because statistically the market is the returns are on my side when it comes to the longer term views. And when you apply a little overlap of the technicals to it, like we mentioned earlier in the show, like the spies and the Qs are retesting those highs from like 4 years ago, coming close to not quite testing that 200-week moving average. To me, that risk reward's okay. I think the S&P was down about 20% near that low, a little more than 20% at that low. And I step into those scenarios knowing well that in the next 3 months, 6 months, next 12 months, even that position can be lower, but its designation as a long-term account, I'm comfortable with that happening, even if there is more downside, because I know I can continue to add at certain key points along the way. Now, focusing on the shorter term account, which I imagine more people in this discussion are focused on, I have not done very much. There's been moments in this pullback where there has been, again, it's with appropriate position size, it's with a well-defined risk reward system. Right now, I don't see anything that is really that attractive to me to be active in this market. Those moments to me were in the second half of February, the first couple weeks of March, and have since really broken down.
Mm-hmm. Okay. So question from the chat. If you don't see anywhere to put your shorter term investments, does eToro offer any sort of yield on liquidity, on uninvested cash?
Off the top of my head, I think the minimum is 5,000 to get the rate. I don't know the rate off the top of my head. It's close to the Fed funds rate.
Oh, dude, that's actually pretty great right now, right? That's a lot more money than I'm making these days, just holding straight cash. RJ wanted to build off Mahesh's question. What are some ways that you look at effective ways to see sector rotation? Like we talked about the 11 sectors. I think you were saying 9 of the 11 are outperforming the S&P right now. Is that what I heard?
Yeah.
How would you be looking to see the rotation around those?
So generally I would just be looking to see like for my first spot I would start is what are the relative performances. So like in this case, we're still pretty early in the year. We're 3.5 months into the year. So it's an easy spot to start and say, where are we on the year to dates? Once we start to get in a little further in the year, I personally feel like year to date kind of loses a little bit of its, not luster, but maybe loses some of its significance, because if something was up 40% and now it's up 20% and you're like, oh, well, it's 20% for the year, it's doing well. Well, not really. It's
Mhm.
coughed up a lot recently.
Yeah.
So right now, I still think it's okay to use year to date. Those 1 to 3 month timeframes are pretty good to use, I think, generally speaking, to see which sectors are performing well. Of course, if you're more short term, more active, you can always scale down into those 10 days, 5-day performances and see really where that strength is. And then, if you're comfortable diving into those sectors a bit, you can always look at the leaders within the sectors, the strength within the strength, or the weakness within the weakness. Really trying to kind of parse out who's doing the leading and who's doing the lagging.
Gotcha. Yeah, one of our people in the chat here, Mikey Mike, says eToro pays up to 4.6% on uninvested cash. That's awesome. That's actually fantastic.
I
Dude,
appreciate him.
yeah, he did the research for us real quick. Joe had a question. It's a sales question. Hope you're ready for a sales question. What is the strategic advantage for a consumer to use eToro versus other services?
The biggest thing for me, I believe, when I came into eToro, I am a retail investor. But when I came into eToro, I think I had maybe lost touch with sort of the basis of a from an education standpoint, from an experience standpoint. I think what eToro really does a good job of is encompassing a sort of learning environment. So it has a social feed embedded into the platform. It's kind of, honestly, it reminds me a lot of Twitter, but it's been around a lot longer. And it's just a way to kind of foster that sort of creative, sort of idea generating type of environment where it's not as all over the place as Twitter can be, and it's a little bit more, it's just more concentrated in finance. You can talk about ideas, you can share your portfolios, you can follow different investors and really get an idea of what other people are doing, how they're generating alpha,
Hmm.
if they're generating alpha. And the other thing I think that's great is it's a multi-asset platform. They have crypto, stock, options. So really a lot of different ways for investors to, get what they want out of the market.
Very cool. I didn't realize that. That's neat. Deep Thought had a question. Will eToro allow UK residents to trade options?
I know that they would love for UK to trade options. I don't know. Unfortunately, I'm not that privy to the UK's operations. I do know it's on the discussion block though, and it's something that they're trying to work towards.
Gotcha. All right. So let me ask you this: Are you comfortable enough talking options to have a discussion on this question? What do you think about straddle or strangle strategies? I don't know your comfortableness on options. What do you think?
Um, Straddles and strangles, they're personally not they're not how I make a living in the options world. For me, I like a lower volatility environment because I do like more of a straight call, straight put situation. But in an environment like this, I think you need a way to offset some of that volatility. So like the biggest issue for me would be with straddles and strangles is IV is so high and you're a net buyer. I think for me, I need a way to offset some of that vol, some of the IV, and then a spread is a great way to do it. If you can collect some kind of credit and offset part of it, that's great. Otherwise, for me, it's just not how I approach markets. I mean, maybe in binary situations, if there's a high tension situation coming up, like Liberation Day would have been a great example. Fed days are great. Earnings situations on individual stocks are moments where I would consider a strangle, but or a straddle, but generally it's not in my wheelhouse to deploy something like that.
Interesting. Okay, so in my personal way of trading, I like to trade deep in the money, long calls and long puts, and I don't get fancy about it. I used to get so fancy about it, Brett. I mean, I would spend hours. I'm not joking. I would spend hours a day like doing different combinations of, I wonder if I sell this and buy this and do that, if I could come up with an almost risk-free trade. I mean, I did everything I possibly, I would even go to bed at night dreaming about iron condors. No joke. That was a real thing. My wife thought I was crazy. But at this point in my career, I don't do anything fancy. Just long calls, long puts, deep in the money. And let's have a discussion real quick about, for example, let's talk about a short strangle. So if we were to use this as an example, so I love options. They're so my thing, as of course I just kind of outed myself that I dream about them. But point being is that, like, let's talk about a short strangle. A short strangle works great if a stock stays within your range here, right? So you're basically selling an out of the money call, selling an out of the money put, collecting the premium, and then hoping that it doesn't go too far in either direction. Sounds like a great idea, right? Sounds like a fantastic idea. A stock can go up, it can go down, it can go sideways, but just not too much, right? Unfortunately, in this type of environment, I think that is a losing strategy, because I can't imagine how much premium you would need to get to offset the fact that we're down 14% in like 39 days. 39 days, we saw a 14% sell off here. And that's not even the worst of it, right? And then let's say you got a long strangle, right? You'd have to be buying those out of the money calls, buying those out of the money puts. And because you're buying both of them, you're paying so much for this. And it's like, how far does it actually have to move? Will it even move that 14% in the next 39 days, right? So, man, to me, this just, from both directions, long or short, just seems like a losing proposition. What do you think? I'm really curious to hear this. No judgment.
I agree with you. To be honest, I mean, if someone is a really sophisticated options trader, they're really disciplined, really know how to approach it, then I think that's a different story. I think probably for like your, I don't even want to say average investor, even an investor who is fluent in options, it's still, options are already difficult enough, I think, to kind of understand, and the way that they're the dynamics that go into options pricing is already complicated enough. So when you start to throw around in environments where you have like a VIX in the 40s and going all the way up and tapping 60, to me, that's just an environment that's really, it gets really difficult. You're a straight buyer of options. So if you're buying a strangle, for instance, like you mentioned on the second example, the IV is going to be through the roof on that thing. Those things are going to be very expensive. And if you're selling it, all you need is a day like today, or some of the days we had a week and a half ago. I mean, that could be a widowmaker when it comes to your trading account. And that's where my issue is with it. And that's why if I'm trading an option in this scenario, I want to do it in a spread, because I'm buying one, but I'm selling another, and it's helping kind of mitigate the blow of that high IV. And it still kind of lets me take a directional basis. If you're just trading volatility, I guess it's a different conversation, but I don't trade just volatility. So
right. Yesterday, I spent a while, because somebody asked a question like, how does implied volatility play into my portfolio? And I was like, not really at all, because for me, I'm looking to trade the deep in the money calls, but I want to go, or deep in the money puts, but I go to around the 80 delta. And what I'm looking for is 20% of the price of the option being extrinsic value, give or take. So for me, it doesn't matter how high IV is. That just has to move me up a couple extra strikes, and then I'm back in the same ballpark for me. But if you're trading something closer to the money, maybe at the money, maybe out of the money, it's going to wildly change how profitable you can be based on how much implied volatility there is. Question from the chat: where's eToro based?
So the U.S. business is in Hoboken, and but the main headquarters for the global company is in Israel.
Oh, really? Do they ever fly you out there?
Mm-hmm. Not to Israel, no. Sometimes we do some international stuff, like in London. London's like a big office for us, so we'll do a lot of our events in London.
Ah, very cool. Okay.
Yeah.
So what would a key, just like if you were to leave our audience with one key takeaway, what would you tell them, especially in a market like this, right, where Nvidia's getting rug pulled, tech stocks are collapsing, right? The market's down 14% year to date. What's Brett's one sentence takeaway for this kind of market?
So my takeaway in this type of market is is what I guess was what I would tell what we tell our clients when we send them market discussion pieces, research pieces. It's a kind of a combination, but it's some of the more simple stuff. It's just reiterating the principles of trading and investing. It's know your time frame, know your principle, know your position size, avoid excess leverage. Those are the things that if you don't follow those along, they wipe you out. There's always another trade. You can always learn from these environments and apply it, because it's going to happen again. We're inevitably going to we've had, we're on the verge, I guess, but you can say we're like in our third bear market in 5 years. It's clear that volatility, I think since COVID, really, we've seen a sort of a regime change in the way markets work. We have more volatility present. We have good moves to the upside, but inevitably we get this volatility. So we're going to be here again. I always try to stress, don't be in a rush. Don't be a hero. Don't like stake the value of your account to just like trying to squeeze a little bit more out, a little more juice out of this, because this thing can unwind so quickly and in both directions, by the way. I mean, if you were short coming into that day where we rallied 10% in the S&P, oh my gosh, man, that probably wiped you right out. So I mean, to me, it's just a reiteration of the principle of general trading principles. And remember that surviving is the number one key always. That you can always live to fight another day.
Dude, I tell people all the time, you need to trade from a risk first perspective rather than profit first, because if you lose everything, right, there is no more trades to be made. It's not Lambos or food stamps, Brett. It's not like that. We're trying to increase our portfolio, right, so that one day we can all be like Scrooge McDuck swimming around in our gold coins. Brett, thank you so much for joining us today. I really appreciate your time. And of course, everybody in the chat, type in Brett to pay respects to Brett, because he took his time out of his busy day to come all the way from eToro through the magic of the internet over here to join us on Outlier. Right? I really appreciate you, and even Salty Brad does. Thanks, Brett. We appreciate you. Thanks, Brett. From Mikey Mike. And thank you all for coming to today's episode. Really appreciate you. Be sure you like and subscribe, and we'll see you on the next episode. Thank you all, and talk soon.